Welcome to the Maximize Business Value Podcast. This podcast is brought to you by Mastery Partners, where our mission is to equip business owners to maximize business value so they can transition their business on their terms. Our mission was born from the lessons we've learned from over 100 business transactions, which fuels our desire to share our experiences and wisdom so you can succeed. Now here's your host, CEO of Mastery Partners, Tom Bronson.
Hi, this is Tom Bronson, and welcome to Maximize Business Value, a podcast for business leaders who are passionate about building long-term sustainable value in their businesses. In this episode, we're going to talk about the current environment for mergers and acquisitions and the impact of COVID-19 on the M&A ecosystem. I'd like to welcome our guests for this podcast. It's Dan Vermeire and Larry Lane. Dan is an investment banker with CFA Worldwide, and Larry is the owner and a business broker with VR Business Brokers. The roles of business brokers and investment bankers are very similar in M&A. To me, the biggest difference is typically it relates to the size of the business and the size of the transaction and how the business is marketed for sale. But there's more to it, but that's a good enough place to start. Both Dan and Larry are located here in Dallas, but they work with clients nationwide. I've gotten to know them a little bit over the past year, and I look forward to hearing their thoughts and insights today. Welcome to Maximize Business Value, gentlemen.
Thank you.
Let's start with Dan. Dan, tell us a little bit about CFA and the role of an investment banker.
Well, thank you, Tom, and thanks for having me on the program. CFA is an investment banking firm. We operate in the lower middle market, which we defined as under 250 million in revenue, down to about 10 million in revenue. We tend to deal with healthy businesses. We don't do a lot with startups or distressed companies. CFA is over 60 years old. We have a dozen offices in the US and another dozen in Europe and Asia. About 4,000 transactions under our belt in a lot of different industries. And CFA is a securities license firm, which is important for this type of business.
So how did you get into the business of investment banking?
Yeah, well, my story is pretty similar to the other deal makers at CFA. We're kind of a boutique firm, which means most of us have some significant business experience. Most of us have owned and operated businesses and sold them and got hooked on the transaction business. I ran a sales and marketing organization for a technology firm, and the marketing side of that started getting into alliance relationships and partnerships. Some of those partnerships started to look like good acquisition targets. So I led that corporate development program, and we did several acquisitions. And then we did a NASDAQ IPO, and then we sold the whole company. And from there, I joined the investment banking world and have been there about 20 years.
Awesome. So tell us, from your perspective, what's the difference between an investment banker and a business broker?
Right. Well, you touched on it originally. You said the size. A lot of people think about the differences all about size of businesses. Some studies tend to use a 5 million revenue as the dividing line. There are a lot of businesses out there with less than 5 million revenue, and that makes up about 80% of the transaction volume, but only about 5% of the value. We see the difference as primarily in the process that we used. The investment banking process is typically aimed at getting a premium deal for the clients, creating a market for a business that is illiquid and doesn't have any market. And so we try to bring multiple buyers to the table at about the same time and create a silent auction effect, all in a very confidential manner. We don't set an asking price. We don't post anything on the internet. It's all very confidential that way. If you think about it, there are some differences in types of sellers we deal with. We're typically dealing with a corporation that has a board rather than a company that's owned by an individual. We deal with different types of buyers. We're often dealing with a private equity group or a corporation versus maybe an individual that's a buyer. And the financing is a lot different. Our world has multiple layers of capital in the stack, senior, mezz, preferred equity, those types of things. And generally, the way we get paid and the way the fees are charged is a little bit different. Oftentimes in the investment banking deal, there's a whole village of people involved. Usually that business owner has advisors that have had long-term relationships with him. And so we're often in the role to quarterback that deal and sort of manage this team of advisors and collaborate as a group.
Awesome. Awesome. Now, just to follow on to that, I know a lot of investment bankers also raise capital, right? Not a sale, but just raise capital. And maybe you said that and I missed it, but is that part of what an investment banker does?
It is, and it kind of varies from firm by firm or even banker by banker as to what they want to specialize in. I think in the market, up until just recently, most folks in my shoes focus on the sell side, on representing a seller, whereas nowadays, raising capital, debt, or some sort of minority equity will come up from time to time, and every once in a while we'll represent a buyer that's doing some strategic work. But anything related to the capital structure of a business and buying and selling deals.
Awesome. Larry, let's hear a little bit about VR and the role of a business broker.
Okay. Well, VR, I bought the VR franchise in 2009. VR is a national franchise organization, been around since the late 70s. There's currently about 50 offices throughout the country. So I own the Dallas area office. As a business broker, I think Dan pretty well laid out the distinction in terms of size of companies that we're typically dealing with. It's really right up to about the minimum of what he was talking about as their minimum. Most of our deals are privately held companies. They're all privately held. And usually a single or single family owner. Occasionally there may be multiple owners involved, but it's typically a single or single family privately held business. Our largest transaction to date was actually $60 million in revenue, but that was a real outlier for our normal business clientele, which is up to that 10 million revenue range. And we're typically working on the seller side. Every once in a while, we may take a buyer profile and represent the buyer to go out and find a business for them. But the vast majority of the time, we're working with a seller who's ready to exit their business. We help them value the business and then take it to market. Taking it to market for us is typically more of a public type of marketing, using the internet for business for sale sites, using our buyer database, which we've created over time. We have about 4,500 buyers in our database, people that have contacted us in the past looking for a business and are still out there looking, or at least they're not unsubscribing to our monthly newsletter or hanging up the phone on us when we call them to try to sell them something. But so we're doing a much more of what I would call a public marketing, still in a confidential way, not to give away the specific business identity, but most of our buyers are going to be people looking to leave corporate America and replace their income and get into entrepreneurship. So that's our clientele.
So is it fair to say that most of your buyers are individuals as opposed to corporate buyers?
Yes, the vast majority. Every once in a while, and as we've seen over the years, the private equity group looks for smaller. They're coming down in the size of deals they'll look at just because the market's tight.
Yeah, they've got to deploy that capital, and so that bar keeps lowering, doesn't it?
Bar keeps lowering, and so therefore we are entertaining some of those deals, but the vast majority of the time it's the single person looking to buy a business to operate themselves.
Awesome. So what's your background and how did you get into the business brokerage industry?
Well, my background is actually in franchising. I was a corporate executive with Fast Signs International, starting way back in the early days. When I joined the company, we had about 15 stores. And I left 21 years later, we were at 540. So my background during that time was working with small business owners, helping them get into business, helping them succeed, and then at a certain point looking to exit and maximize their investment and hard work that they put into the business. And really enjoyed that process, liked seeing the person create a business, start it, build it, exit, and be happy during that whole phase. We always wanted franchisees to be as happy the day they sold their business and walked away as the day they bought it. And so when it became time for me to look at doing something beyond fast signs, that seemed like a good fit for me.
Interesting. Every bit, as you guys know, I've done 100 transactions myself, either as buyer or seller, and I always have buyer's remorse and seller's remorse. So I hope that my seller's remorse is less than my buyer's remorse, but it happens every time, right? So many business owners don't really understand the M&A process. If they've never had any exposure to doing a transaction, they might think of it like selling a house. They get up one day and they decide that it's time to move, and they call their real estate agent friend. They get the house listed, sold, and then they move on in 60 to 90 days. By the way, that's the national average according to Zillow. I looked it up just yesterday. So, Larry, how long does it actually take to sell a business on average?
The average is actually about 7 months.
7 months.
7 months. And we tell people to be prepared for a year. Our listing period with a seller is typically a year. Occasionally, you'll get one done sooner than the 7 month timeline, but it's normally right in that 7 month, and that's a national average via Deal Stats. We keep a pretty close eye on that.
Got it. So, Dan, what does that look like for larger businesses? How much time does it take to sell a larger business?
Very similar to that. I would say 6 to 9 months is what we normally quote, but it could be a year. The good news in that is usually they know who the buyer is after 3 or 4 months. They get to the point of an LOI, engage with a buyer for exclusivity, and begin through a diligence and closing process. But nowadays that process takes a long time, especially if it's a private equity group or an outside bank involved. Diligence does take a long time.
Yeah, in fact, I think that in a future podcast, we're going to dedicate some time just to what due diligence looks like. That can sometimes be a mess, and it's many times when the deal falls apart, right? So Dan, what does the whole process look like, kind of soup to nuts, when you first engage with a client? What does it look like from there until closing? Just the high spots.
Yeah, you bet. A lot of steps involved. The whole point of the process is to get to a point where you have multiple buyer offers on the table at about the same time, so that then the business owner can see some options, get a sense of what the market thinks the value of that business is, and begin to see the cream of the crop, so to speak. And to do that, a lot of preparation is really important. And so we analyze the company and develop a marketing package about the company. We research a number of different industry sectors to try to figure out who might be a good buyer for this business. Then we reach out to them confidentially, provide the materials, answer questions, organize Q&A sessions with the owner, if that makes sense. And at some point, try to get to preliminary proposals. We call those indications of interest. From there, we whittle it down to maybe 4 or 5 good buyers that we would invite in for face-to-face meetings, get a sense of mutual interest with the business owner, and eventually whittle that down to one that we move forward with on an LOI. And then, like I said, a lot of steps to get the deal closed through a lot of due diligence. There's a legal process, further negotiations perhaps with the buyer, and eventually get it closed.
Wow. So, Larry, what about you? Any differences in the steps that you guys take from kind of that initial contact until closing?
Yeah, I would say probably the biggest difference between the processes is, as much as we ideally would like to have multiple buyers at the same time in the process, we're not usually that fortunate. So because of the public marketing side, you're getting an inquiry, you're working with that particular applicant and buyer, and you're either getting them to continue in the process or they're deciding it's not for them and moving on, and you're bringing another person in as the inquiry comes into play. So we're really lucky if we've got a situation where we have multiple buyers looking to do a deal at the exact same time. But we use that process to help sometimes bring the seller to a reality check as to what the real market is. In our size deals, a lot of times the seller, and we've tried to make them, understand the realities of their valuation on the front end, but they're still out there believing their business is still, at this certain level. And we may need the first one or two buyers, unfortunately, that come into play to bring that reality check to the seller. And so I would think that's a big part of the difference in the process. But otherwise, it's similar. Our due diligence on our deals is still pretty extensive, but probably not as extensive, obviously, as some of the ones that Dan is bringing to the table. We do not typically have multiple layers of financing involved. It's typically, a single finance deal. The seller may be carrying some paper to accompany the bank financing that's involved, but it's typically one layer of bank financing, and most oftentimes an SBA type loan is involved. So there's still an elongated process from start to finish because of the due diligence and the financing, but probably just not quite as in depth legally. There's still a purchase agreement typically prepared. We have standard documentation that can be used on a smaller deal if the parties are receptive to it, and if they want their lawyers to review, they can. But if one party's providing full representation, then obviously we need both parties to have it, and that'll elongate the process some as well.
Right. You touched on valuations, and I've often said, there's I can think of 57 different ways to value a small business, and I call a small business anything that is not publicly traded. Right? If it's publicly traded, the value is established by the stock price. But the challenge is, I always say, there's really no way to value a small business until you find a willing buyer and a willing seller who agree on the price. That's the definitive answer to what that business is worth. And I think that many deals are killed in early stages or never really get a running start because that disconnect between what the owner thinks the business is worth and the reality of what a willing buyer is willing to pay. Anybody disagree with that?
It's so true.
It's the biggest challenge. I think it's one of the biggest deal killers out there is really truly understanding what the market is for a business. So we're talking with Larry Lane and Dan Vermeire. Let's take a quick break. We're back in 30 seconds.
Mastery Partners equips business owners to maximize business value so they can transition on their own terms using our 4-step process. We start with a snapshot of where your business is today. Then, we help you understand where you want to be and design a custom strategy to get you there. Next, you execute that strategy with the help of our amazing resource network. And ultimately, we help you transition your business on your terms. What are you waiting for? More time? More revenue? If you want to maximize your business value, it takes time. Now is the time. Get started today by checking us out at masterypartners.com or email us at info@masterypartners.com to learn more.
We're back with Larry Lane and Dan Vermeire, and we're talking about the impact of COVID-19 on the M&A market. Just a few months ago, most people in your industry would say that it was a classic seller's market. The valuations were getting sometimes a little crazy, but they were really good valuations for folks. It may be too early to tell, but how has the market changed in the last 6 or 8 weeks since COVID-19 was announced? Larry, let's start with you.
Okay, well, I would say the biggest change so far has actually been on the buyer side. We had 3 deals in April that fell out because they were under contract. Buyer got nervous because of all the shutdowns, didn't want to continue with the deal before they saw the total, or at least a much more thorough end result of the process, and walked away. So obviously that's a big kick in the gut right off the bat. But I do think the total impact obviously is going to take longer to see. Obviously valuations are going to be affected for many businesses and industries based on how it impacted their financial side. And that'll take a little time I think, to sort through. And then I think for us, probably the next question will be, how does it impact the financing side? Because again, most of our deals are bank deals that are using SBA guidelines for financing. And so it's yet to be seen how much we're really going to be able to get their attention on deals as they're sorting through all the PPP loans and all that stuff. So I think we may be another 30 days or so out. The conversations that I'm having so far with the people that I usually deal with on these loans is, we're still looking at deals. We're still happy to work on them, but you're going to need to be patient with us as we get it through our process and the SBA process and so on. So I think that's the big impact that we're yet to really know.
Yeah, the SBA is a little distracted right now with other types of loans I know that are going on. So, are you seeing what about your stream of buyers and sellers? I'm sure you get inquiries from buyers, you get inquiries from sellers. Has that changed at all since COVID-19?
Well, actually, yes. Dan and I were talking about this just a little bit ago. The buyer's side, the first 3 weeks or so, I mean, we weren't hardly getting any inquiries on any of our deals. The last 2 to 3 weeks, we're actually starting to see a little bit better buyer inquiry flow, which is encouraging. However, the seller side, we're not seeing near as much activity with people inquiring about selling their business as I would have thought. I would have thought this was kind of a pressure point for many of the small businesses, perhaps that are just trying to hang on, this would have forced their hand to say, hey, I need to really talk about, is there an option for me here to sell my business? And we're not seeing the phone ring in that regard as much as I would have thought at this stage. So maybe we're still another 30 days out on that as well.
Interesting, as you guys both already know, our business at Mastery Partners is to help people prepare for that eventual exit, kind of get them prepared for the due diligence, kind of get all their operating systems and processes in order, their financials, those kind of things. We're not an investment banker. We're not a business broker. We refer back out to guys like Dan and Larry when it's time to do a deal. Our business is actually going crazy right now with people realizing that the value of their business may be impacted, and then they should be thinking now way in advance of doing it. So I'm hopeful that will ultimately transition over to deal flow, certainly on the broker side. Dan, what's the impact of COVID-19 in the investment banking world?
Well, it's interesting, a little bit hit or miss, to be honest. We don't see as much impact on the buyer side as Larry mentioned. Most of the buyers have a lot of cash. They still want to try to deploy that cash, put it to work. And if anything, their universe of targets to buy has just gotten a little bit smaller. So they're competing with other buyers more so than they were. So we still see a lot of appetite on the buyer side, pretty much across the board, I guess. On the seller side, it's a little bit hit or miss. It depends on their industry and their business and if they were impacted by the coronavirus. I do a lot of work in the IT space, and most of those have done just fine here. that's still an area of a lot of spend, and businesses have not pulled back. And so the IT services arena is still pretty strong as sellers, depending on who their client base is. Had one prospect that did a lot of business with American Airlines, and you can imagine that they pulled back a bit. One that was involved in the restaurant space, and so of course they stopped. I wouldn't want to try to do a deal involved in oil and gas right now. That would be almost impossible. I mentioned IT services. Food is also a strong area, though the ones that are doing food service to restaurants, they've been hit pretty hard. Had one that did food service to restaurants as well as retail, like in grocery stores and C-stores. And so the grocery store business picked up just fine. The restaurant business came to a halt almost, but they had a lot of product, but it was in the wrong packaging. So they couldn't just immediately move it over to retail, So a lot of challenges that way. So it really depends on that seller's business and how this has been affecting them and if they're still attractive or not. You hear in the industry of kind of a funny term. Most people measure a business's performance by EBITDA, earnings before interest, taxes, depreciation, and amortization. But now we're talking about EBITDA-C, meaning how was your EBITDA before coronavirus? And how does it look like it'll spring back after coronavirus? So it's like we have this little pothole right in the charts of EBITDA here, and people want to be sure that they get back up to speed quickly, So it's funny that way. Another strange effect has been the travel restrictions. And if you have a deal in motion, but it gets to a point where you have to have face-to-face meetings, you can't do that right now. It's kind of a speed bump in the way here in the process. So if you're fortunate enough to be far enough along, you don't need any more face-to-face. You can still move towards a closing. But if it's time to have face-to-face, Zoom can only go so far for that type of thing. And at some point, people want to have dinner together and get to see the place and talk. And so we're having to work through that little travel restrictions problem. Hopefully that opens up pretty soon. But some funny challenges there.
Yeah. So one of the things that both of your comments made me think about is Warren Buffett's famous, the only thing people don't buy on sale is stocks, right? And I suspect that even though we probably don't yet know the full impact of COVID-19 on the M&A market, that it's going to impact valuations. It could be a really great time for buyers who have cash or access to capital to get out there and get some really good buys. What do you think about that, Larry?
Yeah, I would think so as well, if they can look beyond what the impact was, during the time of COVID-19. My take on the market is a good business will always sell. And so if it's got the earnings, then, there'll be buyers out there for it. If you're a buyer and you've got the capital, there are going to be businesses available for that buyer at some point. In the size deals we look at, and I tell buyers this all the time, you have to really be patient, because it's hard to find a good business, a good small business, making money where the seller has it at the right price, reasonable price, at least in the eyes of the buyer, in the marketplace, with an infrastructure in place that makes that transition for the buyer feel comfortable they can take that business on. So you have to be patient, and continue to look and search the field for that right opportunity.
Well, and that's what we do. So thank you for the commercial on that. We help get those businesses ready. So Dan, what about you? Is there always a market for a well-run business?
Yes, I think so. Under challenges like we have right now with COVID-19, like I said, a lot of deals are still in motion. Sometimes it tends to dictate a more structured transaction, where it's all about risk for the buyer. If they're worried that this business might be impacted, or maybe the true effects of the virus haven't really been seen yet, and they might buy this business and it would have some downside that hasn't shown up yet, then we may try to structure the transaction where that risk is shared a little bit between the buyer and seller, maybe through some equity rollover investment or perhaps some earn out or something like that. But if it's a good business with good fundamentals, there's always a market for it. But the overall market does tend to go up and down a little bit, like the tide comes in and out. And even if the business is solid and growing and looks nice, if the financial market is a bit depressed at that time, it's just going to be a little lower valuation than what the business owner might have had in mind or might have seen a year ago or something like that. And so timing the market is very, very difficult. But if it is a well-run business, at least they have the option, from the business perspective, they have the option to wait until maybe the time is right. Although nobody has a crystal ball, you don't know when that's going to be. Like Larry said, if they don't want to go to market right now, this is a good time to work on improvements in the business and have even better value when they are ready.
I disagree with that nobody has that crystal ball. I am that crystal ball. Let me give you two great examples. On May 25th, 2001, I bought a company to turn it around. It was losing money, and we made our first money by August 2001. And then what happened? In August of 2008, I started a new business, a restaurant business, on August 3rd, and 3 weeks later, of course, the market crashed and tanked. So I am a market timing genius working in the wrong direction. So if you want to know when the best time to buy, look at what I'm doing and don't do that. So I am a market timing genius. So to each of you, what actions would you recommend a business owner who is thinking about selling his or her business in the next, let's say, 2 to 5 years? What actions should they be taking? So let's start with Larry.
Well, it's the blocking and tackling routines that I always look at, and that is maximize earnings. Businesses are sold based on earnings, so you want to maximize earnings. You want to have a positive trend in revenue and profits. You want to have a good infrastructure, a good team, good management team will help sell a business almost as much as anything. So you want those basic things in place as you look to go to market, because those are the things that will attract buyers. If you have a business on a decline, if you are the sole business, you don't have an infrastructure, management team, or a second in command or a third in command that really helps manage that business. Those things can hurt you on the valuation side.
Okay, perfect. Dan, what about you? What are the actions that you recommend a business owner take if they're thinking about selling in the next 2 to 5 years?
Yeah, you bet. Well, to me, it's shocking how many business owners don't do anything and don't think about it until the day they're ready.
I agree.
It's surprising. Most business owners don't want to talk to somebody like me, or somebody that's an investment banker, until they're really ready. And that's surprising because they should talk to us, a couple years out and start getting a sense of the lay of the land. But they don't want to be seen with us. They don't want somebody in their company starting a rumor that they're going to sell, or they don't want their customers to hear about it. They just don't want any of that to happen. Normally we have to meet, off-site and use a fake name and things like that. But what they really should be doing is getting ready several years out, and not just the business itself, but themselves personally. Getting their emotions sorted out and thinking about what life is going to be like after selling the business, thinking about that with their family involved, with their personal financial goals and situation. So it's the business, it's them personally, it's their financials, but they should be working on that probably with professionals that help them, financial advisors, family advisors, exit planning people, that type of thing. They should be doing that, 3 years before they're really ready to sell. And that involves improving the value of the business, but it really involves them getting set in their mind about what they want to do and getting their family affairs in order. So assembling a big team is really important. A good team is really important. Considering value improvement programs. I mean, those are really, whether you're going to sell today or 2 years from now, most value improvement programs are really just good business sense. They're good things for the business, whether you sell or not. So starting early is really important, involving a well-rounded team of advisors that can collaborate, for his benefit. That's really important. But it's surprising how many guys just wait until one morning they wake up and they heard yesterday that their brother-in-law passed away or something happened, and that's a trigger for them. And now they wake up that day and they want to sell the business. And sometimes that's not optimal, and they could do better if they did a little bit of planning in advance and got themselves ready.
Yeah, I couldn't agree more. You mentioned something that's kind of an interesting anomaly to me. Because I've done so many deals, I've never made a secret over whether or not the business was for sale. I happen to subscribe to Carl Allen's philosophy. The only reason to own a business is to be able to sell it someday and monetize the value.
That's right.
And I've always shared that with my employees, right? That's made sense. When I wrote my new book, Maximize Business Value, the original title, the working title for this book was The Case for Exit Planning, because that's really what it talks about in here, is how to prepare your business in advance. And so when I had the manuscript, I visited with a number of my clients and I said, hey, would you mind reading this and just give me your input and thoughts, as I finalize the book? And almost universally, I heard, you know what, it's a great book. I love the content, good ideas and all that. But if you're going to put in big bold letters, exit planning on the front cover, don't bring it within 50 miles of my office, right? I mean, right. You get that kind of response all the time. So we changed it to maximize business value. You can see in the little tiny letters, begin with the exit in mind, because that's the way we think about it. As business owners should really think about their value in terms of what is the end game, and preparing for that. You guys have given us some great advice for business owners.
Could I just mention one other thing?
Please.
Yeah, one thing that I think a business owner should do, almost regardless of their timing, is at some point look at getting their business valued, a proper business valuation, because we see so many owners who have no idea. They think they have an idea, but they do not have a real practical idea of the business, the value of their business. And so, they get to the point Dan's talking about, which is, I want to sell tomorrow. They've had it for 25 years. They think because some friend down the street or whatever sold their business for $10 million, that's their retirement and their business. They live the same lifestyle. Their business must be worth $10 million too, although it's a completely different industry, a completely different success rate, performance level and all that. And when you value their business for them, they're literally in shock and think you're crazy. And it's a situation that makes it very difficult, because they can get 20 valuations done, and anybody who knows what they're doing is not going to give them what they wanted to hear. And it's really they're well served if they will just do that, even if they're not thinking about it for 5 years or 10 years, because they'll at least then know, well, this is how it works. This is how the valuation process works, and they can then know what to strive for with help from guys like you to get to that level down the road.
And both of you guys you'll do thumbnail valuations, correct?
Definitely. Yeah, it's very important to us, because we don't want to get started in a 1-year process with somebody whose expectations are way out of line. So we're going to do some work to gather comparable transactions and poll our internal group and figure out what we think that business would sell for in general. Talk with the business owner about it. Obviously, we're not contracting to a price. We're going to go get the best possible price. but we want to know that everybody's expectations are in line.
Yeah. So, and Larry, you do the same kind of a
We
thing,
do.
right?
We do opinions of value on any deal before we list it.
Yeah, that's actually one of the first steps in the Mastery Partners process. We do an assessment, a transaction readiness assessment, where we assess whether or not the business is ready to transact as if it was happening tomorrow across all of their departments. And one of the key deliverables there is an opinion of enterprise value. In fact, you mentioned your friend down the street. In the book, there is a whole chapter on valuations, and I call that country club valuations. Your golfing buddy just sold his business for $10 million. Mine must be worth that as well. So you guys have been great guests. Larry, just one last question on this. What sets VR apart from other business brokers? Because there are a lot of business brokers out there. And how can our listeners get in touch with you?
Well, I think what sets us apart, VR is national franchise. So we have national reach, but local representation. And we have in my office a variety of skills with the people, the agents that work in the office. So we're not focused on one industry. We can serve a variety of industries because of the skills that we have with the people in place. And I think that's a big difference. I think that we are on the front end, brutally honest with folks about the whole valuation process and whether they really have something that is ready to be sold and realistic about what to expect on the price side if we do take it to market. And so I think those are some things that differentiate us. As far as getting in touch, our phone number is 214-733-8282. Our website is vrdallas.com. Email llane@vrdallas.com.
Awesome. And we're going to post these on the website and with this. And of course, folks can get in touch with us. Dan, same question to you. There's a lot of investment bankers out there. What sets CFA apart from other investment banks, and how can our listeners get in touch with you?
Yeah, appreciate that, Tom. I think CFA checks a lot of boxes for people. We're a very experienced firm, 60 years in business, 4,000 transactions under our belt. We have practice groups in 14 different industries. We are securities licensed. That's a big deal for any of the M&A transactions in this size range, where in most cases you are actually selling a security with stock or debt involved. But the main thing about CFA, I would say, is that it's the people. We're what you would call a boutique firm in that our principals, like myself, we lead a project from beginning to end. We don't come in and sell it and then hand it off to a junior VP or something to work on it. So somebody was going to deal with us as a principal from beginning to end. It's a very personal experience for the business owner, and it's very emotional, and it's important to build that relationship. So I think that's what sets us apart, is that our people are very reasonable and can manage the relationship with the business owner over the long term.
Awesome. How can they get in touch with you?
Yeah, call me up, 214-540-8112, or check out our website. It's CFA Worldwide, so it's cfaw.com.
Awesome. So, and of course, I always like to end with my bonus question. We'll start with Dan, since you were the last one. What personality trait has gotten you into the most trouble through the years?
Yeah, it's that filter thing, right? It's I tend to tell it like I see it, and maybe sometimes I should sugarcoat it just a little bit more. But I think business owners like the straight talk, so that would be it.
Awesome. Larry, how about you? What's gotten you into the most trouble?
I'd like to find out what can keep me out of trouble, but I would say in this business, the issue of wanting to be perhaps too helpful sometimes. We get calls from people who, their business is really struggling. They really don't have a whole lot to sell, frankly, and yet we want to help them. So we'll take it on. It's a deal that's not going to pay a lot of money. The small deals can sometimes eat your lunch. Well, they usually eat your lunch time-wise, but you like the person, you have empathy for their situation, and you say, you know what, as long as we're realistic on what we're dealing with, let's work it. And the upside to that is you do feel good if you have success. So that's the plus, but it can be a time.
It can be a real time suck, right? I mean,
Exactly.
Wow. Yeah, absolutely. Absolutely. Well, thank you, Dan and Larry, for being our guests today. You can find them both on LinkedIn. I recommend that you go out and connect with them or at their respective websites, or you can reach out to us and I will direct you to the right place. This is the Maximize Business Value podcast, where we give practical advice to business owners on how to build long-term sustainable value in their business, even during challenging times like these. Be sure to tune in each week and follow us wherever you found this podcast, and be sure to comment. We love comments and we love to respond to comments. So until next time, I'm Tom Bronson, reminding you to stay safe while you maximize business value.
Thank you for tuning in to the Maximize Business Value podcast with Tom Bronson. This podcast is brought to you by Mastery Partners, where our mission is to equip business owners to maximize business value so they can transition on their own terms. Our mission was born from the lessons we've learned from over 100 business transactions, which fuels our desire to share our experiences and wisdom so you can succeed. Learn more on how to build long-term, sustainable business value and get free value-building tools by visiting our website, www.masterypartners.com. That's mastery with a Y, masterypartners.com. Check it out.
That was perfect. I wouldn't make any changes on that.